Alright, so let me just say this straight up. Most people are throwing their money at stocks like they're playing darts in a dimly lit bar blindfolded. Seriously, they hear a hot tip, see a stock soaring, and jump in hoping for the best. But what if I told you there's a way to actually understand what you're investing in, to make decisions based on solid facts rather than just hype or a gut feeling? Stick with me because mastering these fundamentals is literally the difference between gambling in the stock market and making smart, informed investment decisions that can build serious wealth over time. So, grab a coffee, maybe a notepad, because this is the information that could genuinely change your financial future. To excel in fundamental analysis, you must get comfortable with financial statements. Think of a company as a car, and its financial statements as the dashboard. They show how the car is performing, smoothly running, low on gas, or with engine issues. The balance sheet, income statement, and cash flow statement are key to understanding a company's financial health. The balance sheet shows assets, liabilities, and equity at a specific time. The income statement reveals revenue, expenses, and profit or loss over a period. The cash flow statement tracks actual cash inflows and outflows. Cash is king. A company must generate real cash to stay healthy. Finding these documents is easier than you think. Public companies publish them in their investor relations sections. Look for annual, 10K, and quarterly, 10Q reports. Don't get overwhelmed by the numbers. Familiarize yourself with the basic structure and mainline items. Look for trends over time: growing revenue, increasing profits, manageable debt. Financial websites like Yahoo Finance and Google Finance offer summaries and key ratios. Alright, so you've found the financial statements, you've got a basic idea of what they're saying. Now what? Now we need to actually evaluate the company's performance. It's not enough to just look at the numbers, you need to understand what they mean in context. This is where we start looking at key metrics and ratios that tell a deeper story about how well a company is actually doing its job, which is, making money and growing. One of the first things everyone looks at is revenue or sales. Is the company selling more stuff or services over time? Consistent revenue growth is usually a good sign. But it's not just about how much they're selling, it's also about how much they keep from those sales. This brings us to profit margins. You've got gross profit margin, operating profit margin, and net profit margin. These tell you what percentage of revenue is turned into profit at different stages. Higher margins generally mean the company is more efficient and has a stronger competitive advantage. Think about it. If two companies both sell $1 million worth of widgets, but company A has a net profit margin of 20%, meaning it keeps $200,000, and company B only has a margin of 5%, keeping $50,000, which one is in a better position? Obviously company A. It has more financial firepower to reinvest in the business, pay down debt, or return cash to shareholders. So, always look at the trend in margins. Are they increasing, stable, or shrinking? Shrinking margins can be a red flag. Then there's return on equity, or ROE. This is a really powerful metric because it measures how effectively a company is using the shareholders' money, the equity part of the balance sheet, to generate profits. A higher ROE generally indicates that the company is good at turning investments into profits. If you give a company $100 and it generates $15 in profit, that's a 15% ROE. You want to see a consistently high ROE, ideally above the industry average. It's a sign of a quality business. Let's take a real-world example. Think about a company like Apple. For years, they've demonstrated strong revenue growth, maintained healthy profit margins despite intense competition, and delivered impressive ROE. Okay, so you've dug into the company's financials, you've assessed its performance metrics, you're feeling pretty good, but hold on, we're not done yet. A company doesn't operate in a vacuum, right? It exists within a larger economic and market environment, and that environment can have a huge impact on its performance, no matter how good its internal operations are. This is where analyzing market conditions comes in. It's like being a weather forecaster for your investments. You need to know if there are sunny skies ahead, or if a storm is brewing. Think about it, even the best-run cruise ship company is going to struggle if there's a massive hurricane season, or if a global pandemic shuts down travel. Similarly, a fantastic home builder might face headwinds if interest rates skyrocket and mortgages become unaffordable, causing the housing market to cool off. Understanding these broader market trends and economic indicators is crucial because they can create opportunities or pose significant risks for your investments. So what kind of things are we talking about here? Well, there are macroeconomic factors like GDP growth. Is the overall economy expanding or contracting? Inflation? Are prices rising rapidly, eroding purchasing power and potentially company profits? Interest rates, set by central banks, these affect borrowing costs for companies and consumers. And unemployment rates, high unemployment can mean less consumer spending. These big picture indicators paint a picture of the overall health of the economy. Then you have industry-specific trends. Is the industry your target company operates in growing, mature, or declining? Are there new technologies disrupting the industry? Are there regulatory changes on the horizon that could impact businesses in that sector? For example, if you're looking at an oil company, you need to be aware of the global shift towards renewable energy. Alright, we've looked at the numbers, we've looked at the market, but there's another absolutely critical piece of the puzzle, and it's one that often gets overlooked by rookie investors: the quality of the company's management team. Seriously, you can have a great product in a great market, but if the people running the show are incompetent, unethical, or just plain clueless, that company is likely going to run into serious trouble sooner or later. It's like having a high-performance race car, but the driver doesn't know how to drive. It's not going to end well. Think about it. The CEO, the CFO, and the rest of the senior leadership team are the ones making the day-to-day decisions that determine the company's strategy, its culture, how it allocates capital, and how it responds to challenges and opportunities. Their vision, their experience, their integrity, these are all hugely important factors. A strong, visionary leadership team can navigate a company through tough times and unlock incredible growth. A weak or misguided team can run even a promising business into the ground. So, how do you actually assess something as seemingly intangible as management quality? It's not like there's a single number on a financial statement that tells you management score 8 out of 10. It requires a bit more detective work, but it's definitely doable. One of the first things I look at is the track record of the key executives, especially the CEO. Have they been successful in previous roles? Do they have deep experience in the industry? What's their reputation like? You can often find biographies of the top executives in the company's annual report, that 10K we talked about, or on the investor relations or about us section of their website. Look for consistency, a history of delivering results, and relevant expertise. If a CEO has a history of jumping from company to company, leaving a trail of destruction in their wake, that's a massive red flag. Conversely, a leader who has successfully navigated multiple economic cycles or turned around a struggling business commands a lot more confidence. Another thing to consider is how management communicates with shareholders. Do they provide clear, transparent, and honest information in their quarterly earnings calls and annual reports? Or are they evasive, overly promotional, or constantly making excuses? Listen to those earnings calls. You can usually find recordings or transcripts online. Alright, so we've covered a ton of ground. You know how to read financial statements and evaluate company performance. Now, what is this company's stock actually worth? This is where valuation techniques come into play. A great company isn't necessarily a great investment if you pay too much for its stock. It's like finding an amazing house, but if it's overpriced, it's not a smart buy. Valuation is about determining the intrinsic value of a company. The market price is what it's trading for now, but intrinsic value is what it's truly worth. If the market price is below intrinsic value, you might have found a bargain. If it's above, the stock might be overvalued and risky. One common metric is the price-to-earnings ratio, or PE ratio. It's calculated by dividing the stock price by earnings per share. It shows how much investors are willing to pay for each dollar of earnings. A high PE might suggest higher growth expectations, while a low PE might indicate lower growth or undervaluation. But you can't just look at a PE ratio in isolation. A high or low PE is relative. Compare it to the company's historical PE, its competitors, and the market. A tech company growing at 30% will have a higher PE than a utility company growing at 3%. Context is king. Don't assume a low PE is always good or a high PE is always bad. Another method is the discounted cash flow, DCF analysis. It's based on the idea that a company's value is the sum of its future free cash flows, discounted to present value. Alright, so there you have it, a crash course in mastering fundamental analysis. We've covered a lot of ground, from decoding those all-important financial statements and understanding how to truly evaluate a company's performance, to analyzing the broader market conditions that can make or break an investment. We also talked about the critical role of strong leadership in guiding a company to success, and finally, how to use valuation techniques to figure out what a stock is actually worth before you even think about investing your hard-earned cash. It might seem like a lot, but trust me, taking these steps is what separates savvy investors from gamblers. This knowledge is your power. It's the toolkit you need to stop chasing hot tips and start making informed decisions that align with your financial goals. Investing doesn't have to be a casino. It can be a methodical process of identifying great businesses at fair prices. So, I really hope this video has given you a solid foundation and the confidence to start applying these principles. Thanks so much for watching, and I'll see you in the next video.